In this video, we will walk through the key features of Danish withholding taxes on dividends and interest, with a focus on how the rules apply in practice to both domestic and foreign investors. Our objective is to provide a clear, business-oriented overview that can support decision-making around structuring investments into Denmark and managing after-tax returns. We will start with dividends, then turn to interest, and close with practical considerations and typical planning points that corporates and institutional investors should be aware of. When it comes to dividends, Denmark generally imposes withholding tax on outbound dividend payments made by Danish companies to shareholders. For portfolio investors and many non-resident shareholders, the statutory withholding tax rate is 27% at source. In certain cases, this may be adjusted to an effective burden of 22%, but the key practical point is that 27% is typically withheld when the dividend is paid. For Danish resident individuals, this withholding functions mainly as a prepayment of final dividend tax, which is then settled through the annual tax return. For foreign investors, however, the 27% can represent a final tax or an over-withholding, depending on the applicable double tax treaty and the investor's specific situation. Double tax treaties between Denmark and other jurisdictions often provide for reduced withholding tax rates on dividends, typically 15% for portfolio shareholdings and sometimes 0% for qualifying substantial shareholdings, such as where the recipient directly holds a significant equity stake and meets specific conditions. Accessing these reduced treaty rates usually requires that the beneficial owner is a tax resident of the treaty partner jurisdiction and that anti-abuse rules are satisfied, including substance requirements and limitations on benefits where applicable. In practice, even if the treaty allows for a lower rate, Danish payers will generally still withhold at 27%, leaving the foreign investor to reclaim the excess from the Danish tax authorities. This reclaim process requires documentation of tax residency, beneficial ownership, and confirmation of the dividend payment and the tax withheld. Timelines can vary, but investors should plan for a processing period that may extend over several months and ensure that all supporting documentation is complete, consistent, and aligned with the expectations of the Danish authorities. For corporate group structures, the Danish participation exemption can be highly relevant. Dividends paid from a Danish subsidiary to a foreign parent may be exempt from Danish withholding tax if the shareholding qualifies as a parent-subsidiary relationship under Danish law and relevant EU directives or treaties, and if certain anti-abuse conditions are met. Typically, this involves a minimum shareholding threshold, a defined holding period or intention, and genuine economic substance at the level of the parent company. Where these conditions are satisfied, outbound dividends may be paid without Danish withholding, but companies must be prepared to substantiate that the structure is not primarily tax-driven and that the foreign parent is the true beneficial owner of the income. Turning to interest, the Danish framework distinguishes between ordinary interest payments and specific categories that fall under Denmark's interest withholding regime. As a general rule, Denmark does not impose withholding tax on standard arm's-length interest paid to non-resident lenders, including banks and institutional investors, provided there is no nexus to Danish real estate or certain controlled relationships. This broad exemption is one reason why Denmark is often considered a relatively straightforward jurisdiction for debt financing from an international tax perspective. However, there are important exceptions. Interest paid on so-called controlled debt, particularly within multinational groups, may be subject to Danish withholding tax where the recipient is a related party in a low-tax jurisdiction or where certain anti-avoidance conditions are triggered. In these cases, the withholding tax rate can be 22%, aligned with the Danish corporate income tax rate. The application of these rules depends on factors such as the level of ownership or control, the effective tax rate in the lender's jurisdiction, and whether an applicable tax treaty or the EU Interest and Royalties Directive offers relief. If a treaty applies, it may reduce or fully eliminate Danish withholding on such interest, assuming that beneficial ownership and substance requirements are met and that the arrangement is not considered abusive. For investors and multinational groups, a key takeaway is the need to review intra-group financing structures involving Danish entities against these interest withholding and anti-avoidance rules, ensuring that debt arrangements reflect genuine commercial rationales, arm's-length terms, and credible economic substance in the lending entity. Beyond the headline rates and statutory rules, several broader considerations are critical for managing Danish withholding tax exposure effectively. First, documentation is essential. up-to-date tax residency certificates, beneficial ownership statements, group charts, and intercompany agreements should be maintained and ready to submit in connection with withholding tax reclaims or audits. Second, timing matters. Understanding when tax is withheld, how long reclaim processes typically take, and how these timings affect cash flows can be important for treasury management and performance reporting. Third, Denmark, like many OECD countries, has strengthened its anti-abuse and anti-treaty shopping regulations in recent years. Investors should be prepared for closer scrutiny of holding and financing structures, particularly those involving conduit entities or low-substance jurisdictions. Finally, staying aligned with advisors who follow legislative changes and administrative practices in Denmark is vital, as interpretations around beneficial ownership, substance thresholds, and the interaction between domestic law and treaties continue to evolve. To summarize, Danish withholding tax on dividends is a central consideration for foreign shareholders, with a default 27% rate that may be reduced or eliminated through the participation exemption or double tax treaties, subject to stringent conditions and documentation. Interest is, in most standard cases, not subject to Danish withholding when paid to foreign lenders, but intra-group and low-tax scenarios can trigger a 22% withholding that may only be mitigated where treaty protections or EU rules apply, again requiring robust substance and compliance. By understanding these rules, planning structures accordingly, and maintaining disciplined documentation and governance, businesses and investors can navigate the Danish withholding tax landscape in a controlled and predictable manner.